Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and typically join me today, the governor, the mayor himself, the smartest guy in the room, Mr. Michael Becker, but he is on another due diligence assignment for his group over at SPI, so we wish him the best of luck. So in the podcast today, we have the professor himself, Mr. James Eng. James, how are you?
Great. Thanks for having me, Paul.
How's everything going for you?
Great. I mean, spring break here in Texas, so a lot of people are taking some time off, but we decided to jump into a podcast, so we'll get it going.
Let's get it going. What's going on in the Old Capital world these days, James?
A couple things. March 30th, Saturday, March 30th, we are going to have our Hoops for Homelessness over at SMU. So we got 16 teams going to battle it out on the 3-on-3 basketball tournament that we have set up benefiting City House, which is a nonprofit based here in Dallas. And so that should be a great event. If you guys want to come out to that event, you can just go on to Old Capital Podcast and just register just so we know how many seats to put out. And then also following that event, Wednesday, April 3rd, we're going to have Mark Dotzauer over at the Grapevine Convention Center. So that should be, start about 6 o'clock, and then he'll go on about 7 o'clock.
The doctor is in the house. Dr. Dotzer is in the house. If you have never seen Dr. Dotzer, Mark Dotzer from Texas A&M Real Estate Department, he's the retired economist that all the bankers, all the investors want to talk to, kind of get his take about what's going on in the economy. Just not Texas, but the whole national economy. He is the guy that everybody wants to get his opinion about what's going on, to kind of judge about where you should be putting your dollars at in investing. So also too, James, tell me a little bit about this. What's the deal? We've had a lot of great feedback on what's the deal. Tell us a little bit more about what's the deal.
So what's the deal? We thought we'd highlight, so we get a ton of transactions that come across our desk. We wanted to, a lot of times, when you look at an OM or a T12 or a rent roll, you can see the numbers, but you really don't get the full story. And so what we started doing is recording some segments with listing brokers that gave them that opportunity. So we recently did one with ARA Newmark, and they basically took a deal and walked us through, page 1 of the OM to page 30 and sort of told us the story of the deal. And then we also walked through the financing. So what options do you have based on the deal characteristics, the location, the occupancy? What type of financing can we put on that property, whether Fannie, Freddie, or even a bridge loan?
So that's great. I mean, that really goes into the weeds a little bit. So, and that's what you wanted to know. Just like James says, I mean, you'll take a look at one of these offering memorandums and you really have no idea what's in there, but you want to have it explained to you. So that is something that we are going to start doing more often. I think every other Wednesday or so. Look for What's the Deal from Old Capital. So we would appreciate you tuning in to watch that. James, who's the best investor in the world these days?
I mean, a lot of people would say, maybe Ray Dalio, Howard Marks, potentially Warren Buffett. So today, what we're going to go through, every year, Warren Buffett puts out a letter to his investors, his shareholders. And so we're going to cover his February 2019 letter. And I wanted to pull out some of the key characteristics that I saw that should apply to you as a multifamily investor.
So today in the podcast, a little coaching and counseling with James Eng. I would really say that James Eng is the best investor in the world, because we're going to kind of go through Warren Buffett's letter to the investors, but we're also going to put the spin on apartment investing, a little bit of things, some of the things that you should understand when you are investing in apartments, whether you're the general partner or the limited partner in these transactions, to see what the best investor Warren Buffett thinks you should be focusing on. So let's go through it.
All right. So number one, start with your track record. So on the very first page of this letter, it shows the Berkshire return versus the S&P 500. And at the end of it, since 1965, Berkshire has returned 20% versus the S&P of 10%. So essentially, if if investors can achieve a better return than the index, why should they would never invest with Warren, right? So you as a multifamily syndicator, if you can't generate better returns than the US Treasury or the stock market or a REIT, why is an investor going to give up liquidity to invest in your deal, right? So it's always going to be you versus the alternative. And so a lot of people that we work with are in, let's say, multifamily investor groups, or whether it's Lifestyles or Brad Summerall Group, a lot of these LPs are getting deals from a lot of general partners. So how is your deal going to stand out, right? It needs to be better than the alternatives. But then if you go to outside investor groups, those investors might only get 1 or 2 deals a year. But before that, you have to convince them to do multifamily. So what education do you need to put in front of these investors so that they see your track record to make sure that they invest in your deal? And so the last piece on this first one is, Old Capital has arranged over $1 billion in multifamily loans in 2018. And so who do you want to trust with your next transaction? So really, whether you're looking at a general partner or a lender, start with their track record.
I got that. Okay, number 2, communication before the deal.
So all throughout the letter, Warren talks about pricing currently being pretty high for good businesses, but it says they are on the hunt for an elephant-sized acquisition. So essentially the letter is preparing his investors for the day when this occurs. So, when you talk to your investors, how are you preparing them before that ask, before that deal? So how are you building your brand? How are you building your investor database? What are you sharing with investors? And how are you going to do it when you have a deal, right? So think about the education piece before the actual deal. So a lot of people I know, they might have a CRM system like, let's say IMS. They might have people register. They're already ready to go when that deal hits. So any communication that you can do beforehand is going to separate you. And so in terms of the lender also, how's the lender educating you, right? So what market data and property insight can they provide to you before you get into the deal, right? So what communication do you have before the deal? How can they help you see any pitfalls in that particular deal or that particular market? And so if your lender can help you before the deal and they only sort of get in the deal after you're under contract, then, our preference is to really help you before the deal, to help you review deals beforehand so that you get in the right deal the first time.
I like that quite a bit because people come up to us all the time and say, I don't have a deal right now, but I'm only assembling my list of investors. And so it kind of goes back to what you're saying, prepare for the ask. And I put the ask in quotations, the ask. You got to build your list. And I would send out, factual information. If you can get some factual information from some of the brokers about what's going in the market, but also contact your lender, contact James or so and get some factual information about what he's seeing in the marketplace, maybe some interest rates, maybe a case study or so that you can use and just start putting out information into the market itself to your investor base. You may not have a deal yet, but you're preparing to get a deal, but you just want to continue to tweak and oil that machine eventually when you have a deal.
And some investors have actually asked us to come in and talk to their investor group. And so before you might have a meetup or monthly or quarterly event, and you want somebody who's in the market, and we've actually talked at a couple meetups where, given the market update or a lending update and really talked about what's going on in whether it's the Texas market or the nationwide market.
So let's go to deal number 3. Values can fluctuate, but cash flow should be the focus.
So Berkshire earned $4 billion in 2018, but it had a $20.6 billion loss due to unrealized capital gains. And so there was a change in the tax law where you have to mark to market your earnings or your value. And so, Warren was not very happy with that change because the stock market fluctuates daily. And his focus is not on the day-to-day value based on the market, but his focus is on operating returns. So as multifamily investors, in the short term, cap rates might go up, they might go down. it doesn't really matter until you're selling your property. And so focus on your cash flow, keep increasing your NOI until you actually sell. And so on the loan side, there aren't any call provisions or right sizing of loans for Fannie or Freddie. So if you go out and get a 10-year loan, they aren't going to come back in 2 or 3 years and say, your LTV is now 90%, you need to pay down this loan. Their key metric is debt service coverage. So keeping it above 125, and this is really above, based on NOI. And so make sure that you are focused on cash flow and not necessarily the value of the property today.
Yeah, James is absolutely correct. Is that when we make a Fannie Mae or Freddie Mac loan, they're not going to come back with a covenant saying, hey, listen, values have decreased and now we need for you to right size the deal by having a capital call to your investors. Typically, that's not going to happen. So the money's out the door. So they're not asking for us to have the investors bring the money back in. So number 4, buy ably managed businesses that possess favorable and durable economic characteristics at sensible prices.
So this is Berkshire's prime goal in their deployment of capital. Okay, so when you are reviewing a multifamily property, look at what durable, what favorable economic advantage does it have? Is it the location on a busy street? Is it an amenity set that is unparalleled sort of in that submarket? Is it access to a mixed use, or what is that location, whether it's near a school or employer or close to highways, that just can't be taken away from you? And so the way I like to think about it, Warren talks about sort of a moat around his businesses. What is your property's moat? And then how can you add to that, whether differentiating the property or maybe it's service or brand or green updates or technology? How do you keep increasing the size of that moat so that your property's occupancy, if there is a downturn, sustains at 90, 95%?
Interesting. Okay. Number 5, difference between NOI, net operating income, versus cash flow.
Berkshire earned about $17 billion after all of its expenses. So Warren really hates a thing called EBITDA, which excludes all the real cost of doing the deal. So interest payments and taxes. And that's the number that Wall Street actually focuses on. But Berkshire focuses on true net income. And so when running your property, buyers will evaluate your property on NOI. But while you own it, it's really about managing cash flow. And so watch out for those one-time expenses that keep reoccurring. And so in the business world, a lot of times people will put corporate restructuring sort of below the line, in that this is a one-time event. It's not going to happen again. The same way that someone might put, water leaks on a Class C property. This is a one-time event. It's never going to happen again. But you really have to manage cash flow. So, because that is what is actually going to go to your investors. So I like investors who have in their monthly report, they actually show the cash flow, at the beginning of the month, all the things that came in, all the things that went out, and how much do we have at the end of the month? Because a lot of times that first year, you're going to have a lot of CapEx, so you might not have as much cash flow. So just prepare your investors for that.
I think that's another excellent point, James, is that, what's Michael Becker's rule number 1?
Don't buy in the hood.
Certainly is, because some of these older properties that need to have repairs on a constant basis, whether it is piping or old technology with aluminum wiring or GFCI switches, flat roofs, things that have to be fixed, repaired all the time. And you got to look at what's below the line. It doesn't typically show up in your NOI, but it definitely shows up below the line. So name a couple things, James, for people to understand what can be below the line. I think you just mentioned it, water leaks. That's a good one. Or sewer line repairs. Let's kind of walk through what that really means.
Yeah, on some of these older properties, someone might come in and the boiler is 20 years old. And they say, well, it's working right now, so I'm not going to fix it. And then 2 years into their ownership, the boiler goes out or the chiller goes out. And that's, it might be $30,000 or $40,000. And that's a one-time expense. But some of these other things that can come up constantly on C-class properties. The quote that I still remember was I was at, I think it was like a Houston multifamily conference, and they were talking about how they had to hold a C-class property for 10 years, essentially, through the recession, through everything. And the replacement reserve wasn't 300 a door. It was close to 1,000 a door. And so just to keep the property running, it's a constant infusion of capital. And so if you're going to hold these deals longer term, you got to have that capital available.
Yeah, absolutely. We think it's a one-time repair and a below-the-line number. It turns out to be a constant repair every year, day in, day out in these transactions. So take a look and ask the questions when you're going through the transaction. Is this a one-time deal, or did we see this last year, the year before that? So, consider that, kind of go through that. Number 6, never risk getting caught short of cash.
So Berkshire holds 112 billion in treasuries and 20 billion in fixed income. So Warren likes to call Berkshire a financial fortress, and this is key, especially in a downturn. So actually, when I was at GE Capital in 2008, Berkshire gave a loan to GE Capital for $5 billion. And so even though GE was AAA rated, Berkshire was in a position of cash and was able to give a loan to another company to shore up its balance sheet. And so Warren never wants to be short on cash, and neither should you, right? So as syndicators, make sure you raise your money appropriately for your operating accounts, for your downturns in cash flow. But then also when you're looking at, and some investors do this well. So in their webinar, in their investment pitch, they have a sources and uses. And the smart investors will actually raise money for that year one insurance because you have to pay it at close. They raise money for the 3 months of real estate tax escrow that you have to have. They raise money for an operating account so that they can actually do the rehab and then get reimbursed from the lender. So make sure you have all those numbers in there in that first year, because you don't want to be caught short of cash at the very start of your investment.
Yeah, and that's something that we do see all the time. People do get short of cash or start off short in cash, and they fail to raise enough cash. And they think that if they raise too much cash, it's going to take away from the rate of return to their investors. I say raise more cash than you think you need, and then after the deal closes, maybe a month or two later, after you get your hands and your head around this deal, then return the capital to the group if you wanted to do that, not as a distribution, just as a return of capital. But never get short in these deals without having cash up front. So number 7, what is generating cash so that you can invest?
So Berkshire has 4 main groups of operating companies, but the 5th is an insurance company. So an insurance company collects premiums up front and then pays out claims later. But in the meantime, while they're holding this money, it's called float. And essentially that is cost free. And if you underwrite correctly, it actually generates a profit. And so currently there's about 122 billion in float that Berkshire holds because of its insurance businesses like Geico. And so when I see that, I mean, it's almost like this cash generating machine that Berkshire has. And, for you as an investor, how are you generating cash to invest in deals? Are you putting deals together to create the equity? Are you working a normal job to generate cash? Because multifamily is not a no money down investment. When an investor emails me and says, what's the down payment on the deal? That is like a sign to me that they don't know really what's going on in the deal, and they're trying to get into the deal for the lowest amount possible and asking me about seller financing. On multifamily deals of size, you have to put cash in the deal. As an LP and as a GP, you have to front earnest money, loan app fee, good faith deposit, legal fees. So before you really get into multifamily, figure out a job or business that can create cash for you while you're looking for deals to invest in.
Hard money. Do you ever see people asking, what's your hard money? Can I get hard money?
Oh, hard money loan.
Yeah, hard money loan.
Sometimes, but it's pretty rare.
Is that a tell typically?
It's a tell if they think that they're going to get 95% financing and get 5% carry back from the seller. That's a sign.
That's certainly true. So You probably could do hard money in single family business, 1 to 4 units, but on multifamily, that is a little bit of the kiss of death. That's a tell for me that we really are not talking the same language, because in these transactions, you do need to have some cash, lots of cash in these deals. And if it does need, structure financing, it's going to be a bridge loan. It's not going to be a hard money loan where you're going to pay a couple points and get a rate of 17 or 20%, whatever. Those numbers just don't work. The spreads are not enough to carry and pay that type of a rate of return, even for a short period of time. So number 8, do not focus on short-term results. Have a long-range focus. That's a great one.
So Berkshire does not give quarterly numbers. They never have a number to hit. They have seen it lead to, the Enrons of the world, the fudging of numbers, and forcing companies to make bad decisions. So, it's March 30th and you need an extra $100 million in income. So you sell the property, or you get rid of a business that maybe could make a ton of money later on. So, in multifamily, sometimes you have to turn over the rent roll. Sometimes you have to take a dip in occupancy, because if you just kept the occupancy at 95%, you could never do your business plan. And similar to, switching from lender to lender to maybe win a deal, or, you go to a lender, it saves you a couple basis points, or, it might come back to bite you. So build a relationship with a lender. They will help you on future deals, future assumptions, supplementals, CapEx draws. So have a long range focus in the game, because if you're going to be a general partner for a long period of time, or a limited partner, we're going to be here for a while, and your real estate's going to be here for a while. So keep a long range focus as you go about your CapEx plan, and also when you're going about raising equity.
Multifamily is not a short-term investment. It never has been, never will be a short-term investment. We kind of take a long-term approach to everything. We'd like to do 10 or 12-year fixed, even 30-year amortizations, maybe even 35-year fixed rates. We want to keep interest rates as low as possible for you on a cash flow basis. So if there is a problem in the future, you're not going to feel it, because your maturity is not for 10 or 12 or 15 or 20 years. So we kind of take it. So I know that a lot of people have made a lot of money in short-term investing in multifamily, but the future is not what the past has been for the last couple of years. So look at long-term horizons. Don't look at short-term horizons. Protect your balance sheet as much as possible. Don't expose your balance sheet to future problems if maturities come at bad times. Number 9, full transparency to investors is everything.
So Berkshire's audience is not analysts. It's not commentators. Warren is working for the shareholders. So the numbers that come to him are the ones that he sends out to the investors. And it's the same way as a general partner. You should be doing the same for your LP investors. To me, more communication is always better. I have never heard a LP investor tell me, this GP just communicates way too much. Most often, it is the exact opposite. They might get an email a quarter. Get your investors out to the property, or create a video for your property of what you've done on the property so far, what CapEx. Show them where their money is going, and give them that full transparency. I think when you do one deal and you treat your investors right on that first deal, it's not just those investors coming along on your next one. It's all the referrals that you get from that first group of investors. And so treat them right.
A lot of your clients, James, do a great job of communicating that information out there. So that's the way to not get into trouble, is overly communicate everything. Number 10, government owns an interest in your earnings after tax returns.
So Warren put this a very interesting way. Berkshire, as a corporate company, he said was owned, in quotes, by Congress. They essentially had special AA shares in terms of tax payments at 35%. But in 2018, that was reduced by 40% to 21% of their total. And so consequently, investors receive a large boost in earnings just from this change. And so understanding your after-tax return in multifamily investments is key. And so how much are you paying the government of your return? And are you sheltering any of that income either through depreciation or 1031 exchanges? understanding the tax piece of this business is very important. So if you as a general partner cannot explain that to a limited partner, you might be missing out on potential investments from LPs.
Yeah, I always thought that my wife was my biggest partner. It's not. It's the government is my biggest partner. Number 11, all about underwriting.
So we talked about their insurance business previously. So they have $122 billion in float from their insurance business. And in the last 16 years, the insurance business has made a profit in 15 of the last 16 years. So that means it's received more premiums than it's paid out in terms of actual payouts. So while many insurers, he said, give disciplined underwriting lip service, he said at Berkshire, it is a religion. And so how good are your general partners at underwriting deals, whether it's expenses or knowing rental comps or knowing upside? You have to know the underwriting of a deal to make sure that the investment is going to work. And so it's really all about underwriting.
It's all about underwriting, but number 12, use debt carefully.
And so in the letter, it says, at rare and unpredictable intervals, credit vanishes and debt becomes financially fatal. And so he fashioned it or showed it as a Russian roulette equation. You usually win, but occasionally die. And so it might make sense for someone who gets a piece of the company's upside, but does not share in its downside. And so how much cash does the general partner have in the deal? Is it all carried interest? Are they taking short-term loans to make sure that, you get to a certain return? But then if that doesn't work out perfectly, then you might get caught in a downturn and you potentially could lose all of your equity. And so number 12, use debt carefully.
I would also probably bang the table about preferred rates of return, because that is a form of a debt too. Talk a little bit about that when it comes to multifamily, James.
Yeah, I mean, essentially a preferred return says you as the LP get paid first and the general partner does not get paid anything. And so if a property is only performing at 5 or 6% and you guaranteed a preferred return of 8% or 9%, you're just digging a hole and you're not going to be able to get out of that hole. And so some general partners will just toss in the towel at that point and then all your equity is gone. Versus if you have, let's say, an 80-20 split between the general partner and limited partner, those two people are, if the return is 6%, you're still getting 20% of that return as the general partner. So you're able to, be a part of the deal, and you typically have cash in the deal as well. And so you're going to be more committed to that particular deal.
Number 13, distribute earnings prudently.
And so Berkshire has essentially retained all its earnings and used compound interest. And essentially in 1965, they started with 22 million in earnings. And currently it holds 349 billion in earnings.
Sure.
And so, you as the multifamily investor, as a general partner, you should distribute a percentage of your earnings, but definitely hold some back for the rehab, for, let's say, lower occupancy, unexpected CapEx, and then pay it out at the end. I mean, a lot of these investments are illiquid. It's a 3 to 5 year hold. And so you just don't want to start on that sort of downward spiral. I'm short on cash. I can't turn that unit. So I take, the appliances from one unit, put in the other, and all of a sudden you got a down unit. That becomes worse. And then, your criteria becomes worse in terms of who you lease to. The tenant base gets worse. And then all of a sudden it's the downward spiral that leads to sort of lower and lower occupancy until you just can't recover. And so you just don't want to start that cycle. So make sure you have enough set aside and potentially maybe do a monthly distribution and then come back with a special distribution either on an annual basis or at the end of the deal.
I think that's a great idea. Number 14, defer taxes as long as possible.
And so Berkshire, they deferred over 28 billion in taxes due to accelerating the depreciation of assets like plant and equipment. And so they'll continue to purchase every year these assets the same way as you, an investor, whether you're doing cost segregation and accelerating your depreciation in year one, really in order to offset gains every year, you're going to have to keep investing every year into different deals. And so just keep that in mind and make sure that if you do receive a big gain, and I've seen sellers do this, get the gain in January. and figure out a way to reinvest that money so that it offsets by the end of that calendar year.
Makes sense. Number 15, get over historical pricing.
So in 1976, Berkshire purchased 50% of Geico for $47 million. Okay, 50% for $47 million. In 1995, about 20 years later, Berkshire purchased the remaining 50% of Geico for $2.3 billion. So 50 times what they first paid. All right. So a lot of people will say that was just way too much. Why did they do that? But since 1995, Geico has made Berkshire $15 billion in profits in that time frame. And so many investors are sort of stuck on price per door 5 years ago. So they said, this property traded for 20 a door and now it's trading for 70 a door. It just doesn't make sense. But you have to evaluate the deal based on the cash flow it's generating and then based on what's your alternative to invest in and move forward with the best information on the deal. And so, rents are probably up 40 to 50% compared to where it was back then. And so the values of these properties have just gone up, and the days of 20,000 a door might never come back.
Number 16, and we only have one more to go. Pick the right jockey.
So the CEO who ran Geico from 1995 to 2018, a guy named Tony Nicely, took Geico from seventh largest insurance to the second largest and increased sales by 1,200%. And so it increased Berkshire's value by $50 billion. And Warren spent a page in the letter thanking Tony for his service. So when choosing investments, make sure you have the right jockey in the seat. So Berkshire made the bet on Geico because Tony was in the seat and it grew exponentially. So as investors, make sure you know who's going to be running your investment for the next 3, 5, 7 years. And then even going sort of one level down closer to the property, the GP should know the regional, should know the property manager, the leasing agent. They are the day-to-day interaction with the customer and are running your $10 million business. So make sure your staff is the best at what they do. In the same way, at the beginning of your transaction, or even when you start looking at deals, choosing the right lender, one that can get the loan closed, but then also help you win deals, meet investors. All of that goes into picking the right jockey.
I think Robert Kiyosaki says it probably pretty clearly that by investing in real estate, you really have inside information, just because you're not going to get a chance really to talk with the president or the CEO or any of the board members of Cisco Systems or PepsiCo or IBM. But when you own real estate in these small syndications, you can talk to the general partner. You can talk with some of the other people that signed on the note. You can talk with other investors. You kind of have this feeling that you are in control of this investment, this transaction. So I think that's probably the biggest thing is when you buy into syndications or you become a limited partner in syndications, you have a direct line with some of the decision makers that can help you with your investment. So I think picking the right jockey is important, but picking the right investment is probably the most important in the right area, the right transaction, the right debt, the right limited partners as team members on the deal. So I do like real estate. Number 17, and the final one, James, is understand fees and the impact on returns.
So he gave an example. If you put $1 million in the S&P 500 in 1942, when Warren started, it would be worth $5.3 billion today. So 11.8% annual return from 1942 to today. But if you paid an investment manager 1%, so you received an annual return of 10.8, the total would be cut in half. So 2.65 billion. And so that's over a long period of time, but that just shows you an example of understanding fees and how it impacts you. So, when you're reviewing your PPM or even your investment memo from GPs, are they taking acquisition fee, disposition fee, lending fee, loan guarantee fee, asset management fee? How is the GP aligned with the LP in terms of percentage of profits? How much risk is in the deal for the LP? And does this have a chance of going to zero? So at GE, my chief risk officer used to say, don't take equity risk for debt returns. In essence, it meant you're putting up a majority of the money And if this deal goes perfect, you get none of the upside. But if it doesn't go right, you're holding the bag. So make sure you analyze the deal, understanding cash flow, understanding how much is coming from cash flow, how much is coming from residual sale, and how much of the profit goes to the GP and how much is going to the LP. And are they taking, aggressive debt to make this deal work? And so understanding those fees and then its impact on you is key. And so
everybody has those little phrases. I remember as a young banker, I think I like this phrase, limited upside, which means that we will only get 4 or 5% rate of return on our money. But we have unlimited downside, because if we pick the wrong borrower in the deal and they put the deal into the ground, then we have to take the deal over, pay the back property taxes, pay the insurance on the deal, fix the problem. It becomes an unlimited downside of the deal. So picking the right jockey is very important. Understanding the fees and the impact on returns is very important. Anything more to add to this, James?
No, I think, Warren Buffett's one of the best in the world, and he's grown Berkshire tremendously. And we should all hope to create a portfolio as profitable and large. But I think we can definitely learn some lessons from Warren that he's learned over his 88 years.
So Warren is the oracle from Omaha. James Eng is the professor from Plano. I definitely like that. Some of the things that you do, James, which I think are outstanding, you have a kind of a 3-part series video that kind of explains a little bit more about lending, for one, and then talk a little bit about that, and then the 17-page white paper report that you've put out, which I think helps people understand a little bit about transactions, how they get financed.
Yeah, I think the white paper definitely gives you sort of the lay of the land in terms of whether it's a bank recourse loan, a Fannie loan, or Freddie Mac loan, sort of which ones to go into. And then if you get into the webinar series, which you can see, go to oldcapitalpodcast.com, and on the right-hand side, you can see the webinars. The webinars really go into the granular detail on these deals and sort of take you step by step, whether it's the loan process for each one or the key nuances of each one, and shows you sort of examples and case studies on these particular loans, so that when you see a property, you can say, all right, maybe this will work Fannie, maybe it can work Freddie. And after seeing the case studies, you can see investors who use those particular loans.
So just like number 9, full transparency to investors, that's what James does, is full transparency to you as an investor, as a general partner, as an LP. He has some great collateral information that you want to get. So go to the Old Capital Podcast website, download that information, and some great information. James is the professor from Plano. Great job. We appreciate your time. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.